Good morning, everyone, and welcome to this morning's webinar, which is Funding Your Business to Drive Growth. My name is Esther Carter. I'm a partner at MKS, and I'll be doing a bit of light chairing this morning. So for those of you, I know many of you will be familiar with who we are, but there'll be some of you who are slightly less familiar with who we are. So MKS is a leading audit, tax and advisory firm. We work with entrepreneurial businesses across all sectors, as well as not-for-profit and private client. And we're also part of More Global, which is an international network. We have presence in over 100 countries, so very well placed to help you with your international growth journey. So whether you're a startup seeking seed funding or an established company looking to expand, funding your business and raising capital is a vital part of your business's journey. And navigating that fundraising environment can be quite a daunting task for entrepreneurs and business owners alike. So in this webinar, our panel of experts are going to offer some insight into that fundraising environment. They're going to be talking about what funders are going to be looking for, and we'll highlight some of the challenges around raising capital. So I'm delighted to be joined by Marcus Jennings. He is a fixed income and macro strategist at Schroders. I hope you all know what that is because I'm not quite sure I do. But nevertheless, he specialises in developed markets, sovereign bonds and foreign exchange investing. Sounds very complicated, Marcus. Hopefully you'll simplify some of that for us when I'm asking you the questions. He has nearly 10 years experience and he has an in-depth knowledge of the global economy. And whilst focused on developed markets in general, he has a particular interest in the UK. Guy Taylor is a corporate finance partner at Moore Kingston Smith, and he specialises in debt advisory services with a focus on private equity and corporate clients. He has extensive experience in raising various types of debt, including real estate, working capital, asset-based and leveraged debt across multiple industries. And Guy's experience also extends to corporate finance and private equity acquisitions, dividend recaps and shareholder restructures. So this webinar is for everybody that's logged on. So please do ask questions as we go along. Please do put them in the Q&A function, not the chat function. Much easier for me to keep track of them in the Q&A function. And I will seek to weave those into the questions that I'm asking Marcus and Guy as we go along. And any unanswered questions they can respond to privately at the end. The session is being recorded, so please do share it with any of your peers or colleagues or friends who are unable to make it this morning. And at the end of the session, we will be putting up a little questionnaire. Please do fill that in because it really helps us to shape future webinars. So let's kick off then. So Marcus, just starting with you. So to sort of to set the scene before we go into the outlook for the Bank of England and interest rates more broadly, could you just give us a sort of brief overview of how the UK economy has been performing recently and the outlook?
Sure. Firstly, good morning to you and good morning to everyone online. Thank you very much for the opportunity. It's great to speak with everyone. I guess you're just taking that question in two parts, really, thinking about what's happened and what's going to go on going forward. If you cast your mind back to late last year, I think many of you will know that the UK did witness a recession. It did experience a recession, albeit quite a shallow one. It was quite a lot shallower than a lot of people were expecting at the time. And since then, it's nice to say actually there's been some brief positive news for the UK, which I think many will share that this is a rare occurrence over the last couple of years. So, broadly speaking, I'd say growth has been quite a lot better than people expected in both the first quarter of this year and the second quarter. So much so that people are certainly becoming a lot more optimistic on the outlook ahead, which is great to see. What I would say is, though, looking at the details of growth and the underlying drivers, it's not necessarily on a firm footing at this point in time. So the consumer is yet to really show proper signs of life. So you and I and others are not really going out and spending aggressively at this point in time. Businesses are not investing in CapEx hugely, but I would say there is light at the end of the tunnel. And certainly from an outlook perspective, I'm certainly becoming ever more constructive on growth going forward. And we're certainly past the worst for the UK, with a recession very much in the rearview mirror, which is good to hear. What I would say is let's not get ahead of ourselves too quickly on the growth side. Now, this quarter is shaping up to be okay, but I think as we transition towards the back end of the year, and more importantly as we go into next year, I think there's real signs of optimism actually that are coming through. Now, you may ask the question, why am I optimistic on growth? I think a few points to really cover off there. I think credit conditions have eased across the macro economy. It's easier to get credit than it was 6, 12, 9, or 12 months ago. I think that's helping growth. I think the fact that consumers' wages are growing at a faster rate than inflation, no doubt we'll come on to inflation in a bit, is certainly a positive. And if you look at both consumer and CFO confidence, that's on the rise lately. So no doubt that will probably eventually feed into higher spending, higher capital expenditure going forward to drive growth. I think the final piece of the puzzle is lower rates are really starting to help. Now we'll talk about this a bit later, but there has been an easing of financial conditions. There has been a lowering of mortgage rates across the economy, albeit moderately lately. And I do think that's really sort of helping the housing market as well. So 2, 3, maybe 4 tailwinds to have a slightly more positive outlook going forward than, let's say, of the last 6 to 12 months.
Well, that's good. But Guy, what's your view? Do you share the same view?
Yeah, I think as Marcus has said there, I've seen we'll come on to it, but I've seen loan pricing come off a little bit over the last, I suppose, maybe a bit more short term in my world, and I work in a particular part of the market, but yes, I've seen loan pricing probably in the last 6 months fall 25 to 50 basis points in a sort of typical leverage transaction, and quite a lot more competition in the debt fund market, where they were looking to charge, say, 6.75, 7 on loans a year ago. That's probably fallen by 50 basis points or more, as all of those debt funds have realised they need to keep lending money and the competition's come back to the market.
Okay. And Marcus, you've spoken about growth, but what are the latest inflation developments in the UK and sort of the outlook going forward?
Yeah, very topical, because I actually had the inflation release just yesterday, actually, and I think I've got a chart here, hopefully everyone can see it, just to bring this to life a little bit. And I guess if I was to focus your attention on one line, it would be that sort of thick purple line, which shows headline inflation. So the rate of that prices are going up over the year. And as you can see, it's around sort of 2.2, 2.3% really. Now that held steady compared to the last month and is off the lows that we saw a couple of months ago. So not necessarily great news in the short term, but cast your mind back to, let's say, late 2022, you can actually see that inflation was in double-digit territory. Many reasons for that, the energy price shock being a big contributor towards that. So what I would say is that the UK has made pretty decent progress on bringing headline inflation down over the last year or so. But the devil really is within the detail, really. And with that, if you look at the dark blue line, which is services inflation, you can see that's running at a much hotter pace of 5.6%, really. And I think this is the important point when it comes to the Bank of England, which we'll talk on in a bit. But 5.6 services inflation is still very strong in a historical context. And from an investment point of view, we really want to see that come down over time. We think it will, but it's going to take some time, really. I guess drilling into the details, what is driving that services inflation? Things like rents are very high. Landlords are still putting up prices quite aggressively. Recreational services are still quite strong, suggest there is still some pricing power amongst businesses for eating out and so on and so forth. So all things considered, I think we are heading in the right direction when it comes to inflation development. But I think the Bank of England cannot be too aggressive on thinking about easing policy when services inflation is 5.6% and core inflation. So that takes out things like energy and food, so volatile items. So core inflation is running around 3.6%. So still quite a long way from target, I think, is the conclusion. But the trajectory going forward is one of a slowly normalizing inflation picture, but it will take time to get back to 2% target, in essence.
I mean, what does this all mean for the Bank of England, sort of gilt yields and corporate funding, bond rates more broadly?
Yeah, it's a good question. I mean, ultimately, the Bank of England do have an inflation mandate. They target 2%. So that is what they really want to see core inflation trending down to over time. What I would say is, this chart in front of you shows you the Bank of England base rate over time. Many of you will be aware we have had one interest rate reduction back in August. It was a close call where it was a 5-4 vote, where 5 members of the committee voted for a reduction, 4 didn't. So really quite a decisive indecisive decision, and there is certainly not a outright majority, a strong majority on the committee to reduce rates a lot. Now, going forward, and today is actually, another day where the Bank of England may or may not reduce rates. My expectation and the market's expectation is that they won't change rates, unlike what the Federal Reserve did overnight. But what this chart really shows is, the profile for what the market expects the Bank of England base rate to be going forward. So in a nutshell, they think the Bank of England will ease probably a few times this year and then a bit more next year, taking that bank rate down from 5% currently to sort of mid threes. Now, I think in terms of sort of relaying it to gilt yields will react quite closely to what the Bank of England does, really. So no doubt gilt yields have come a little bit lower and financing rates have come lower, as were touched on earlier. So there's an embedded easing already into market pricing. They're expecting the bank to ease. Now, my personal view is actually, the market's probably got a little bit ahead of itself in the short run in terms of how much they're expecting the Bank of England to ease. So I wouldn't be surprised if gilt yields did just tick up a little bit, not a lot, but a little bit in the short term. But I think if I took my sort of short-term hat off and thought more broadly and longer term, I'm pretty confident the inflation progress we're going to make is, pretty good over the next quarters. And that will give the Bank of England a green light to ease, probably a bit more aggressively come 2025. And the medium-term path for gilt yields, broader financing, such as mortgage rates, corporate funding rates, is probably a little bit lower over the medium term. But just don't get ahead of yourself and expecting an aggressive reduction would be my conclusion.
Yeah, thanks, Marcus. And what about sort of risks to this view on gilt yields that maybe are worth people sort of considering?
Yeah, I think that, look, there's always in my world, there's always risks to consider, really. And one of the risks, which is very topical, specific to the UK, is the budget that's coming up. October the 30th. There's a lot of mood music around what the Chancellor will and won't do. Tax rises are clearly going to come through, but I think what we have to be very aware of as investors and sort of thinking about financing conditions are just how much extra or not will the government want to borrow. Now, we're all very familiar with what happened in September 2022 with the mini budget. To be clear, we're not expecting a repeat of that. I think Labour have been very clear they do not want to see a repeat of that, but the market will no doubt be very acutely aware of if Labour do go on a significant spending spree, that actually may cause gilt yields to rise because of them having to issue a lot more bonds in response to that. Not our base case, but I do think that is an upside risk, really. I think just one other risk really is actually if inflation doesn't really come back down, let's say wage inflation and broader inflation in the UK economy stays around 3 to 4%. Now, I think that would be real headwind for bringing corporate financing rates lower from here, because as I said, the market's already expecting them to come down. So if there were signs actually inflation was getting stuck, that would certainly be a cause for concern at the same time.
Thank you very much, Marcus, and we'll come back to you again later on. But just sort of moving on to Guy, I guess it's really interesting to hear about the macro environment, but a good segue into you, Guy, in terms of sort of asking about where the banks and the debt funds are with their pricing for typical deals in the UK.
Yeah, thanks, and hello everybody. Morning. So yeah, I mean, what's a typical deal? So we here at MKS do lots of different types of deals. S has already mentioned, growth financing, property deals, things like that. So what's a typical deal? I think for the purposes of our discussion this morning, let's call a typical deal a leverage type deal. So it's a transactional sort of deal. So MBO, private equity private equity acquisition, corporate acquisition, cash out, dividend recap, that sort of thing, right? EOT. So leverage transaction.
Guy, you mentioned dividend recap. I'm not sure everyone might know what a dividend recap is actually.
So look, thank you very much. So thanks very much for that, and please stop me if I'm talking jargon. I will fully explain as requested. So a dividend recap really would be if either paying out a large dividend, so you are raising money to pay out a material profit. Maybe you've got a large P&L reserve, you'd like to pay that out. So that would be doing something like that, paying a large dividend to the shareholders. Or it can mean, I mean, it's sort of terminology in the mid-market. It can mean paying loan notes back from a transaction. So for example, if a deal was done with a private equity house, that deal will typically be done on a mix of loan notes and real equity, typically mostly loan notes. Let's just say you do a deal day one, 3 years later, you've gone from an EBITDA of 5 to 10 million. Nothing else really has changed in the transaction. You've got a debt package there that has some capacity. So maybe you did that deal at 3 times leverage on day one. And leverage, and again, I'll sort of define things as I go, but leverage is just a simple ratio. It's just basically your total debt number divided by your EBITDA. So if you've got 15 million of debt and 5 million EBITDA, that's a three times leverage. So leverage gearing, same sort of word. What I'd lost my train of thought there. What were we talking about?
You talk about different types of transactions, whether that's an MBO deal or a dividend recap.
Yeah, dividend recap. So typical transaction. So I'm gonna define typical as that sort of transaction, a leverage deal. And I'm going to say it's not a huge deal. So it's a sort of mid-market or lower mid-market deal. People in the financial markets have different definitions for lower, mid, large cap, but just for our purposes here, let's just say a deal where the EBITDA is between 1 and 10 million. You need to really have £1 million of EBITDA before you can go and raise leverage debt. There are people that will give you money for businesses that in the growth phase, or there's venture debt providers, and there's people that lend on thing called ARR, which is annual recurring revenue. So you can borrow money if you have a software business that's in a growth phase. But just for the purposes of my talking about pricing here today, we're talking about those sort of key mid-market leverage transactions. So that's typical. That's what I'm going to define as typical. And then we go on to pricing. So those loans are priced on a reference rate plus the margin. And in this market, the reference rate for these deals is something called SONIA, which is the Sterling Overnight Index Average. And Marcus will know a lot more about this than I do. But effectively, what that rate is the rate that financial institutions pay to each other for overnight deposits. And it's used and collated, checked by the Bank of England and published every morning. And that rate is used as a reference rate for these leveraged loans. So you have SONIA plus whatever the margin is, and it's written as S plus margin. And SONIA today is 495, I think today. It's not really changed, and it typically tracks base rate-ish. And it's a replacement for what the Bank of England used to use, or the market used to use, which was LIBOR. And I'm sure a lot of the people on this call will have read in the press about LIBOR and why that rate was discontinued. But effectively, there was some alleged fraud in the market and manipulation of that number. So the powers that be in London decided to use SONIA, which was a rate that was much less open to that sort of manipulation. So pricing is always quoted as SONIA plus margin. So there are two parts to it. And as Marcus has said, those rates have risen over the last couple of years. Both the reference rates have gone up to historic highs, and the margins have also increased for various reasons that we probably won't go into here, but really for the macro reasons in the economy, things like, as we all know, inflation, the Ukraine war, uncertainty, et cetera, et cetera. So those prices have increased in the last couple of years. But in the last, again, as we've just mentioned, in the last 6 months, those prices have fallen a little bit. And as I said before, probably between 25 and 50 basis points. I'm not sure if you've got anything to add to that, Marcus. Did I define SONIA okay there?
Perfectly.
Okay. Thanks very much. So if we go back to what I think the pricing is, and all deals are different. There's a whole spectrum of transactions, and everything is priced on its merits. But if we look at bank deal today, there are three providers into the leverage market: high street banks and some international banks, like people like Investec. There are and debt funds. And we could go into a lot of detail here, but debt funds do tranche their own money. So they will lend money into mezzanine transactions, which are quite expensive deals. They'll lend money into unitranche transactions, which are sort of the mid-market and slightly cheaper, lower geared deals, which we call stretch senior. But I don't really want to go down that road. Let's just talk about banks. So bank pricing for a typical deal, and let's say a typical deal today is 3 times leverage. the more leverage you put on a deal, the more risk there is for a lender. So the more expensive it will be. But if we say it's 3 times, I think amortizing debt. So banks typically will either give you amortizing debt, so debt where you have to pay capital and interest, and non-amortizing. And they will charge you a different price for those two products. Non-amortizing debt is more expensive. That's generally called TLB. Amortizing debt is less expensive. That's called TLA. TLA today from a bank, and again, there will be outliers here, will be about 375 to 425, something like that. And non-amortizing TLB debt will be 4 to 475. And again, there are outliers there, and there are people that will do cheaper prices for brilliant deals and more expensive for deals they think are less good. But that's typically where banks are today on those sort of transactions. With regard to the debt funds, and we have hundreds of funds now in London offering this money. It's a huge market today, and more often than not, I used to work in leveraged finance as a lender. I worked for a couple of banks, and when I was lending money in 2000 before the crash, 2006, 2007, there weren't many debt funds around. Today, there are a lot of those transactions, and to be fair, most of the deals that we do, especially with private equity, are now funded by debt funds. And those debt funds will give you a little bit more leverage, typically, and they'll give you more flexibility on your terms. And we'll get into all that. But debt funds really now charging something like 5.75 to 6% margin. And remember, these rates I'm quoting are added on to SONIA, so we're talking about lending rates of between 9 and 11%. So still some way off the historic lows where people were borrowing this money at a total cost of say 5%, 5-6%. So borrowing costs today is still a lot higher than they were a couple of years ago. And there's a sort of middle ground between bank lending and this sort of unitranche debt providers called Stretch Senior, and maybe the pricing on that today is sort of 5 to 5.5. So anything from 375 to 6.5, basically, in that leverage market, with outliers either side.
Super, thanks, Guy. I'm just going to remind the audience, please do ask questions. We haven't had any yet, so first one to ask.
Please do. Please put us on the spot.
Yeah, exactly. Think of something really difficult.
Yeah.
Well,
you've got a monologue from me.
Yeah. So when making a lending decision, what is it that banks are looking for? I mean, what does good look like?
Right. So probably the first thing, so I've had this with colleagues over the years, probably the first place to start, because I have worked in businesses where we've got an equity side and we've got a debt side. So the equity thinking is very different from debt thinking. And sometimes my equity colleagues couldn't quite understand why a bank or a lender, why they love the deal, but a bank didn't. And they would be miles apart, right? So let's just talk about that quickly, which I think is just important background. If you are if you're a provider of equity, you're an equity investor, what are you looking towards? You're looking towards the upside. So you are providing expensive money. So equity typically would be really costing you 30% plus. So they're looking to invest what is expensive money for a high return. And they're doing that in the expectation that, say, 3 or 4 years down the line, that business will have doubled, tripled its EBITDA, and they can sell that business and do very well. Those businesses work on a portfolio basis. Let's just say a private equity firm has got 10 assets in its book, and it doesn't want to lose any of those assets, but there's a chance it might. But if it does, the return for that fund will not be totally destroyed. So they can take some risk. They can afford to take some risk, and they're looking more to the future of that business. A lender is much more focused on downside risk. A lender is only charging their money out to their, let's call it 5-6%. So if they take on a loan and lose £20 million, that is a lot of lending they need to do to get that money back. So lenders are very, very concerned and mostly concerned that the business that they're investing in does not go backwards. That if it's making £2 or £3 million on day one, that it only goes forward or stays stable. They do not want it to come off. So they will do everything they can to diligence that business in lots of different ways to make sure it's resilient and it will not go backwards. And there's lots of things they look at to do that. But I just wanted to make that point. It's lenders and equity providers look at making their investment decisions in very different ways. So it's all about downside risk and downside protection with a lender.
Well, they make the money in very different ways, don't they?
Yeah. So it's large numbers, small return, private equity. Obviously some of those numbers are massive, but the returns for private equity are many times that of a lender. So lenders need to be much more careful with their money.
And what you talked about, banks wanting businesses that are resilient. What do you mean by resilient? What does resilient look like?
Yeah, I mean, there's lots of different. So a lender will go through a credit process when they're making a loan, and they will do things like run through a diligence process. That diligence process might include financial diligence, due diligence. They look at lots of different areas, but in summary, let's keep it simple. What are the key areas that they look at to determine whether that business is resilient? And the first one, as soon as somebody gets a pack of information through the post from somebody like me or a company, they'll go and look at the financials of that business, the historic financials. That's the first place you go. So has that business been stable for a number of years, and has it been growing? So number one, it needs to be stable. Number two, if it's growing, that's brilliant. Has it had any drop-offs in its performance, and why? Can those drop-offs in performance be explained, and are they likely to happen again in the future? Lots of lenders will also go back to the COVID years and see what actions were taken at that time, how badly the business was impacted, and make a decision as a result of that, make a decision as to the resilience of that business and the survivability of that business if there's another major shock. They'll also look in detail at things like profit margins. So profit margins are seen as they're seen as a proxy of value add for a customer, right? So if you've got high profit margins, you're seen as a high value business to your customer, but they're also seen as resilient to future financial shocks. So if you have a very fine profit margin, for example, like Tesco's, obviously that's an awful example because Tesco's is a very resilient business. But if you have a business with a very fine profit margin, your ability
carpet shops.
Well, yeah, I mean, low value add, low margin. So generally, low value add means low margin, and low margin means the inability to defend future economic shocks. So, for example, if you have an issue with your cost base, or you have a few months where you haven't made sales, you're not making no money. You're not making a loss. So your ability to weather a storm is much harder if you have very fine profit margins. So lenders don't really love very fine profit margins. So good profit margin, good stability, good weathering of COVID, and no real holes in your historics. That's basically that's a sort of number one stop for a lender when they're looking to determine whether this is a good lend and resilient. Probably the second thing they look at is, again, it's financial. Takes a while to get past the financial page when you're looking to lend money. It would be what we would call quality of earnings, and people define this in lots of different ways. But if we talk about quality and sustainability of earnings, and I'm talking about your profit figure. So when you're presenting your profit figures to an investor, is there anything that makes up that number that can be questioned? Are there any unusual costs in there? Any costs that shouldn't be in there? Are there any add backs? So quite often when people are presenting EBITDAs, they're adding back in sort of one-offs or so amounts that they think are non-recurring. Are they really non-recurring? Why are they in there? Are they just normal trade costs? So is your EBITDA solid? Will it stand up to a due diligence process? Are you investing enough in the business? So have you come up to either sell a business or raise money, and you've tried to maximize your EBITDA by cutting back on certain expenses? So lenders will look into that. Have you got an underinvested business? So no one likes that. And like as I said in overview, will that quality of EBITDA, will it stand up to a due diligence process, a third party looking at it? And then the second part of that quality is sustainability. So lenders will look at things like, do you have a good forward order book? What's the quality of that order book? What's your sales function like? Do you have any long-term contracts that mean that your revenue can't just be shut off one day? Do you have can you look forward and see that revenue recurring? Do you have any recurring revenue? And recurring revenue would be revenues like the sort of revenues that some accountancy practices have. So, for example, audit clients come back every year typically. Tax clients come back every year typically. Do you have revenue that could be fairly described as recurring? Do you have any subscriptions in the software sector? There's been a move in the last few years to software as a service, to subscription basis. That is seen as a very reliable income stream by lenders. So sustainability of your future income streams is important. So we've got the financials and then EBITDA quality, and then there's lots of other points under that, and we'll just run through that because we don't have a huge amount of time. Probably the next most important one is the quality of your management team. It's ideal that they get on. That's always a good thing if you've got a management presentation. So you would need to, at some point, the management team would need to present to a lender the strategy of the business, what they've done, where they're going, your financials, things like that. So you need to have a good, credible management team. The lender also needs to be confident that those management are going to stick around for a while. So are they properly incentivized? Are they likely to leave? Are they happy? Are they good? So yeah, having a good quality management team with great CVs, their experience in the business is probably the next thing. And are they going to stick around? Another couple of things, I think the next most important would be how banks look at your market positioning. So we can come on to sectors, but in your market, where are you in that market? Are you seen as a good provider? Do you have a strong position? Again, this will be determined partly by, or banks will look at partly your EBITDA margin here to look at value add. But are you a quality operator in the market? Do you have a growing market share? What are the threats of competition like in that market? What are the barriers to entry like? Is it easy to get into the market, or does it take years? Do you need a level of IP? Do you need the right people? Are those people hard to recruit? So do you have strong defensible business that's got a good position in that market? Have you got happy returning customers? So a lot of people look at net promoter scores and things like that as part of a diligence process, and they'll look online and they'll see what people are saying about you. So market position, offering, are your customers happy? Just two other points I think are worth making. Banks will look at lots of things, but your management information is key. Lenders will not like to go into a transaction. You see this quite a bit on entrepreneurial businesses as they move from that sort of growth phase into the more mature phase. So you've got one guy that's been maybe doing a bit of everything. Maybe he's got a bookkeeper or an FD. If you're borrowing money from a professional investor, you typically will need to have linked management information, so proper balance sheet, cash flow, and profit and loss account. That information will need to be reliable. The base data will need to hang together. Ideally, not lots of different spreadsheets in a business, but you have businesses at different stages that move through that. That can be acceptable. It depends. Yeah, does everything hang together, and are you able to provide MI on a timely basis? Typically, 30 days would be the limit if you're borrowing money from bank. And then the final thing I think to mention would be sector. So banks will have a view on sectors. There will be sectors that they don't like, and that will be based on recent experience. They might have lost money in a sector. There will be sectors that they don't like for macro reasons, and there will be sectors that they don't like for reputational reasons. So it'd be quite hard to raise money, for example, on a coal power station at the moment. Anything that's sort of seen as environmentally unfriendly. Gambling is a difficult sector. Anything that's involved with the sort of bombs and guns part of defence and things like the adult industry, that's going to be a no for lenders. And then with regard to the macro environment, as Marcus has been talking about, sectors that would be potentially seen as more challenging in a downturn or a market where there's a cost of living crisis, for example, businesses affected by discretionary spend. So consumer products, maybe sort of mid-market consumer products, not the cheaper or the higher end, the sort of the mid-market. Hospitality, some hospitality would be more challenging at the moment. And then there's sectors that people love. As I mentioned before, software, because of its metrics, it's a very sticky sector. Once you've put a piece of software into a business and you're paying on a subscription, quite a sticky product and very difficult to remove. And healthcare, you know, high value, high profit margin, things like that. So sector is obviously important. I think those really are the key things. Lots of other little bits and pieces, but I think they're the key things that would make a resilient business for a lender.
Thanks, Guy. I mean, just picking up on the point about quality of management information, I can't stress enough how important it is to invest in your finance team. I see so many high growth businesses going out there with a view to doing a transaction, not investing in their finance team because they think it's an easy win to keep costs out of the business, and then it just all goes horribly wrong when they're going through a transaction or making acquisitions and trying to integrate them, and it just all falls over. So investing in finance team, a definite one I would I would encourage people. I mean, if I'm sitting here as a business owner, you know, what are the sorts of things I should consider before embarking on a debt raise? Because obviously the alternative is that I go out and get some equity. I mean, there are different ways of doing it. If I'm going on a debt raise, what are the sort of things I should think about?
Yeah, I think you know, they're probably similar, right? You need to well, we'll talk about them, but I think they're probably similar things if you're looking equity or debt. You know, you just need to you need to really get your house in order. But let's just run through them. I think when I've had lots of initial meetings with people about raising debt, and generally the first thing they say is, I want to raise X and I want to pay Y. And they focus on the quantum and they focus on the price, but they don't focus on the flexibility and actually what they want. So the first thing I'd always suggest is that you think about and you define very clearly what your objectives are for your business over the next sort of 3 years. I know it's very hard to do that into the future, but 3 years you should be able to say, look, I need to make an acquisition. I want to do this. I want to purchase this asset. I want to pay these people X, Y, Z. So you need to sit down with your management team and you need to decide what are your aims for that business in the next 3 years. What you thinking about doing, and you make sure that you include that in any financing process that you undertake, and you make sure that you don't put any unknown banana skins into that process. So yeah, you need to define what your objectives are, what you want to achieve, and what the most important aspects of the next few years are for you. So, you know, like I said, acquisitions, any capex, any future debt you might be thinking of putting onto the business, all impact where you get to, and you need to make sure that those points are covered, because what you'll be doing when you take a piece of debt like this is you'll be signing up to a document that's 200, 300 pages long, which restricts you in lots of things. So you need to make sure that those restrictions have been thought about earlier on rather than later on. So yeah, I think just think about what you need and where you're going in the next few years. That's the key. And then, you know, start looking at other things. And those other things would be you know, understand that you are putting a level of financial risk onto your business, and understand what that level of risk is, and take steps to understand that. So you will be paying material interest, you'll potentially be paying capital, you'll have less cash in the business going forward. It'll be quite a different balance sheet maybe than you're used to. You will need to make sure that you have enough working capital for your business going forward. And as I've mentioned before, there'll likely be some restrictions on your business. For example, limits on capital, on capex spending, limits on dividends that you might have paid out historically, and limitations on things like other financing and security on the business. So I think what I'm saying is you need to run some sort of downside case. So you need to run a funded model with your proposed debt package in the business, and you need to flex a few things, whether that be turnover, gross profit, cost base, just to make sure that you understand the level of flex that your business can go through, and you can still pay your debt. Because if you don't pay your debt, like everybody who doesn't pay their debt, there's some consequences, and that consequence typically is your bank, you know, as a worst case scenario, ask for their money back. If they can't get their money back, then they'll take steps to do that. So you just need to be sure that you understand that level of risk, I think, on day one, and that you've done that. And the third point is probably, I think we've hinted at it already, and you've just mentioned it already, Esther, is make sure you're ready. And that typically means, is your contracting in order? Is all your legal paperwork in order? Is your financial, reporting structure robust? Are you producing information on a timely basis? You will need to go through a financial diligence process at the very least if you're raising this sort of money, which will be an investigation into all sorts of things in your business, but primarily the financials in your business, your cash generation, your working capital, your forward order book, things like that. So are you ready for that sort of process, and is your house in order? That's probably the third thing. You already mentioned it.
I had a question come in actually, which I think is a very good one from one of my clients actually. Well done. Are there any rules of thumb with regards to personal guarantees? Because I must admit that's one of the first questions clients always ask me when we're talking about debt. Am I going to have to any rules of thumb with regards to personal guarantees?
Right, yeah.
Am I going to have to put my house on the line?
Right.
Am I going to lose it all if it goes wrong?
So really, I think personal guarantees are really only relevant in smaller lending. So where you're not engaging with, for example, the leverage. So on any, I've done quite a few leverage deals in my time, and we've never had a PG. So never had a PG on a commercial, this sort of commercial loan at this sort of size. Do you run into issues at the smaller end of the market? Yes, you do, and you would need to make sure that you're going to as many people as you can to make sure if you can get rid of that personal guarantee. I'm not sure of the loan size that your client might be looking at, but typically it's at the smaller end of the market and the higher risk end. I've been talking about, sort of fairly material deals where, maybe the minimum lend is sort of 3 million up to say 25, something like that. But if you're looking at smaller lending in the smaller market, yes, PGs are more typical, but I can't speak for sort of lending under say £1 million because I don't have a huge experience in that sector. That will be other people in the business. And that lending is sort of done more by brokers and smaller ABL type providers, and smaller ABL type providers will typically charge what they can get away with. But yeah, no real rules of thumb other than on a material deal, absolutely not. And for example, there are people in the market that will try their hand even on larger deals and ask for some sort of PG, but no, you need to, typically that needs to go. No PG on a material deal.
Super. Thanks, Guy. We are getting near to the end of our session. So I think it's worth just coming back to you, Marcus. Obviously, we've had a lot of information today. Just on to leave our audience with the key takeaways.
Sure. I think if you're going to take 2 or 3 points from my session, at least, would be the following. Firstly, I think the UK economy weathered the rising financing costs over the last couple of years pretty well and better than expected by many people's standards. And I think the important point going forward is we're now coming down the other side of that interest rate profile. So, Bank of England will continue to ease going forward, and that will be a positive for growth. Now, I think growth may not be fantastic in the very near term, but I think if you're a medium term, if from a medium term standpoint, things are looking a lot rosier. So I think there is room for optimism there, which is good news. I think the second point is really around inflation. Now, headline inflation, so that's everything in terms of the inflation basket, will probably tick up a little bit just purely because energy is set to rise. So you'll probably see headlines of that coming in the next few months. But I think core inflation, i.e. you take out those volatile energy and food components, will gradually head lower over the medium term, so the back end of the year. Why is that important? I think this is my third point. It's core inflation, which the bank really are focusing on quite heavily, and what that means for gilt yields and financing costs more broadly. And I think whilst very near term markets may have got a little bit ahead of themselves, I think if you're thinking 6, 12, 18 months down the line, gilt yields will be a little bit lower. And bring it to corporate financing costs, that will help bring things down a little bit, but not a lot really.
Super, thank you, Marcus. And Guy, what would your sort of top
very briefly
points be? Very briefly,
yeah, as we're running out of time. Okay, I think I've talked about already, but just define your objectives. Make sure you understand what you're going to be doing in the next 3 years, and work from there when it comes to your financing. Make sure you understand your downside risk. Undertake a downside case model. Number 2. Number 3, which I haven't mentioned, which is don't take your eye off the ball through a process. If you're into a debt raising process and you're going through a diligence process, your number one job is not to get through the diligence process. Your number one job is to make sure that business doesn't fall off during that process, because if it does, you probably won't get the financing away. So you need to make sure that the business delivers over that financing implementation period and that you don't take your eye off the ball.
Super. Thank you, Marcus, Guy. That's been fascinating. I think we've all learned a lot this morning. I just remind everyone to fill out those feedback forms. Like I say, they are super useful. And our next webinar is actually on the US election and its impact on the economy. So I imagine that will be of interest to many of you as well. So look out for the invite for that. So thank you very much, everyone, for attending. Remember, it was recorded, so do share it with your peers and colleagues who missed it. Cheerio for now and enjoy the rest of your day. Thank you.
Thanks, everyone.
Bye-bye. Bye-bye.
Bye.